Hello students, welcome to the lecture series on international business. We will continue with our current topic, that is overview of exchange rate system, and this is part 6. This is the last part of overview of exchange rate system. In this lecture we will discuss factors affecting exchange rate determination, exchange risk and exposure, and monetary policy framework. Now, to understand the factors affecting exchange rate determination, before that we have to go back and discuss the types of foreign exchange market prevalent, because some of the foreign exchange market types are a kind of a ready solution to any exchange rate risk also. So, here we will discuss the different foreign exchange markets, and we have discussed a few of them in one of the lectures on overview of exchange rate system. So, spot market, forward market, futures, options, swap transactions and arbitrage. So, these are the types we are going to discuss in this lecture first. So, first of all, it is spot market. As the name suggests, spot market is that segment of foreign exchange market where currencies are traded for immediate delivery, that is on that particular day only. Although theoretically it is true, but practically it takes 2 more days to settle the transaction. So, we say that the term is immediate delivery which is used. In practice, delivery takes place 2 working days after the transaction is complete. The day on which delivery takes place is known as the value date or settlement date. The rate applicable to on the spot trades are known as spot exchange rates. The spot exchange rate is the price at which one currency can be traded for another on the day of transaction. So, here on the day of transaction, whatever is the exchange rate prevalent, that will be applicable. The other variant is forward market. As the name suggests, forward market is that segment of the foreign exchange market where currencies are traded not for immediate delivery, but for delivery on any future date, say after a fortnight, 30 days, 90 days and so on. So, the rate governing such future transactions is known as the forward exchange rate. Forward exchange rate denotes the price at which one currency can be traded for another in future time period. So, you are deciding about that now, but you are talking in terms of future. So, that is forward market. For most major currencies, forward exchange rates are quoted for 30 days, 90 days and 120 days and so on. These rates can be at par, premium or discount compared to the spot exchange rate. Then comes another type of foreign exchange market, and that is futures. And futures contract is quite similar to forward contract, but they are a little different from the forward contract. So, what are the differences then? So, forward contract is customized or tailor made for the client by his international bank. So, whether you are playing forward for 30 days, 60 days or 90 days, it is for you. It is not applicable to everybody. A future contract has a standardized features in terms of size, maturity, date, etc. A forward contract does not require margin, but in case of futures it is required. So, margins are required in respect of futures contract, and an initial margin must be deposited into a collateral account to create a futures position. So, here a little bit of security money you have to submit. Futures are traded only on an organized exchange. In a future contract, actual delivery does not take place then and there. So, on the due date, the difference between the spot rate and forward rate agreed under the contract is settled. So, here actually there is no physical transfer as such, but the difference is earned by the, or the loss is borne by the buyer or the seller. Now, coming to another method, which is options. Futures contract though it protects the buyer from adverse changes in exchange rates, it eliminates the possibility of gain from the favorable changes. So, an option is a contract because in futures most of the time you are using it to have a security kind of thing, to keep you secured from exchange rate adversities. But in case of option you can earn also. So, an option is a contract that gives its holder the right to sell or buy the specified quantity of an asset at a specified date in future. So, there can be two type of options, call option or put option. So, call option is an option to buy and put option is an option to sell. Then another variant is swap transactions. So, simultaneous sale of spot currency for the forward purchase of the same currency or the purchase of spot for forward sale of the same currency is known as swap transactions. The spot currency is swapped against the forward. A swap is also known as double deal. So, basically you are building a kind of an immunity for yourself so that the losses will not fall on you. Then another method is arbitrage. It means simultaneous buying and selling of foreign currencies with the intention of making profits from the difference between the exchange rate prevailing at the same time in different foreign exchange markets. So, you are buying in one foreign exchange market and selling in another foreign exchange market on the same day to earn profit. So, that is arbitrage. Now, coming to the next topic for discussion in this lecture, and that is factors affecting exchange rate determination. Now, exchange rate move in line with changes in demand and supply of currency, and this is in case of a free or floating exchange rate system. There are various factors then they cause changes in demand and supply of currency. So, these factors will of course affect the exchange rate. So, two important factors are relative price levels and relative income level. So, let us discuss the impact of these two factors on exchange rate determination. First is relative price levels. Change in relative price level influences international trade pattern. Inflation in home country dampens the demand of domestically produced goods in foreign as well as home market. So, inflation interferes in this whole mechanism. So, the outcomes are exports may decline, that is demand for domestic currency falls, or the supply of foreign currency in home market falls. And another outcome may be imports rise. So, import will rise, demand for foreign currency increases because residents want to purchase cheap goods from abroad. So, that is the outcome of when inflation takes place. Then the resulting demand and supply pressure causes foreign currency to appreciate against the domestic currency. So, that is interference of relative price level, that is inflation is leading to increase in the value of foreign currency. Hence, the change in international trade activity due to changes in relative price level results in depreciation of the currency of the countries that experience high rates of inflation. So, you must have understood that with inflation, the foreign currency will become more stronger, it will become stronger in comparison to your domestic currency. Then another factor which has an impact on exchange rate determination is relative income level. So, changes in income level influences purchasing power, hence the demand for domestic as well as imported goods. So, increase in income causes imports to increase. Obviously, the demand for foreign commodities will increase as your income is increasing. This implies that demand for foreign currency rises as people need foreign currency to pay for imported goods. Increased demand for foreign currency leads to appreciation in the value against the domestic currency. So, again when the income level in an economy is rising, the impact will be that the foreign currency will become stronger. So, if we want suppose our income increases and we want more of US products, because now we can purchase, our purchasing power has increased, but what will happen? There will be higher demand for dollar, and that is why the dollar value will appreciate and your rupee value or the domestic currency will depreciate. Now, another topic, the next topic that we are going to discuss today is exchange risk and exposure. So, exchange risk means the possibility of loss due to fluctuation in rate of exchange between two or more currencies. So, you know that this is a robust mechanism whereby the demand and supply curve is determining the exchange rate every day, every moment, and this fluctuation leads to exchange risk. It is the net potential loss to a firm with foreign exchange exposure which can arise from changes in exchange rate. A company engaged in export import is affected by a change in the rate of exchange between the domestic and the currency in which the transaction is designated. Types of exchange risk and exposure. There are three types of exchange risk. First is transaction or conversion exposure. Second is translation or accounting exposure, and the third is economic or operation exposure. Let's discuss these three types of exchange risk one by one. The first is transaction or conversion exposure. This is most common that we have discussed when we were discussing exchange risk as well. It means the risk associated with change in the exchange rate between the date of the transaction and the date of its settlement. It is concerned with changes in cash flows arising out of existing contractual obligation. So, you have entered into a deal on a particular day and it will be settled in a future date, and by that time there is a change in the exchange rate and you may suffer a loss. So, that is the transaction or exchange risk. The degree of exposure depends on unsettled receivables and payables or non-executed export or import orders. So, conversion of foreign currency receivables or payables into domestic currency will take place on that day, and that is why this type of conversion exposure will be there. So, if you are delivering, and which is highly unlikely that you are entering into a contract delivering the goods on a particular day, getting the foreign exchange on that particular day only, that is quite impossible. So, there are time lags between the different stages of a transaction, and during those stages the value or of your currency or of foreign currency may change or the conversion rate may change, and because of that there is a risk. The second type of exposure or exchange risk is translation or accounting exposure. It arises when a company, it has a number of subsidiaries in different countries and it has assets and liabilities denominated in foreign currency. So, translation risk is higher when a company holds a greater portion of its assets, liabilities or equities in a foreign currency, because what will happen, as these assets and liabilities have to be shown in the financial statements in domestic currency and you are holding it in foreign currency, there will be a change. So, incorporating foreign assets, liabilities and income in parent company's financial statements will be a problem and a risk will arise. So, this is known as translation or accounting exposure. The third type of exposure is economic or operation exposure. It refers to the effect of unexpected changes in the exchange rates on the future operating cash flows of the company. The value of the firm is measured by the present value of its expected future cash flows. So, here we are talking about cash flows. So, you know that when we invest in any other country or in any foreign currency, then we expect cash flows over the period of time, but there may be changes that may happen. So, a change in the exchange rate can alter a company's future revenues and the costs and thereby its future cash flows. As a result, the actual net present value of the company may differ from the anticipated value. This is the effect of exchange rate changes on future cash flows. Economic risk are also known as forecast risk. Such type of risk is usually created by macroeconomic conditions such as the geopolitical instability and government regulations. So, that is about economic and operation exposure. You know that uh, as US government put some tariffs on our country, that reduced our chances of increasing our value of our cash flows. But now the things are better, as now they are entering into an agreement to reduce the tariffs. Now, when exchange risks are there, there are methods of managing exchange risk also. So, we will discuss the methods of managing exchange risk. So, there are internal methods and external methods of managing exchange risk. So, we will begin with the internal methods of managing exchange risk, and these methods are exposure netting, denomination in local currency, foreign currency accounts, leads and lags. So, first we will discuss these internal methods one by one. So, first one is exposure netting. It means managing the size of receivables and payables in a foreign currency in such a way that they match with each other. The loss in payables is offset by the receivables and vice versa. Denomination is local currency is the second method. The exchange risk can be totally avoided by denominating the transaction in local currency. So, you do business in local currency and then the possibility of exchange risk will reduce. Here the other party to the transaction will bear the exchange risk, the other party from other country, they will bear the exchange risk because you are transacting in local currency. So, many of the countries, they have stopped transacting in dollar and they have started transacting in their local currency with foreign buyers or sellers. Foreign currency accounts. The large scale manufacturer exporter can minimize his exchange risk by maintaining an account abroad through which the transactions are routed. So, he is exposed to exchange risk only for the net balance as exports can pay for imports. The loss of exchange is converting from foreign currency into domestic currency, that is avoided. So, this is foreign currency accounts if we maintain. Another method or internal method is leads and lags. Exporters and importers try to hasten or postpone the time or receipt of the payment of foreign currency on the basis of their estimates as to whether the currency will depreciate or appreciate. So, in leads and lags, you have to do forecasting or trend analysis. So, with that you can find out what will be the situation in future, so that you can minimize your exchange risk. So, you will transact like that, you will take decisions for that. Now, coming to the external methods, and there are three external methods of managing exchange risk: hedging, futures and options, and we have discussed these methods when we were talking about the foreign exchange markets. So, here we will try to enter into the exporter or importer, they will enter into two simultaneous transactions to reduce their exchange risk. So, first of all is hedging. It means establishing an offsetting currency position so that loss or gain on the original currency exposure is offset by a corresponding gain or loss on the currency hedged. So, this is hedging. Another is futures. So, on the due date, the difference between spot rate and forward rates agreed under the contract is settled. So, this is futures that we have already discussed in foreign exchange markets. Okay, so by that you can so on a particular date you are entering into spot rate and forward rate is also there. You will settle the transaction so that the losses will not be created. Options, here in fact you can gain out of your decisions. It gives the buyer the right to buy or sell a given sum of foreign currency at a predetermined rate on a future date. On the due date, the buyer of the option may or may not exercise his rights. So, there is a put option and sell option available to you. If you are gaining, then you will take the decision accordingly. Now, finally, we come to the last portion of this series, that is overview of the exchange rate system. So, this topic overview of the exchange rate ends with the monetary policy framework. So, let us discuss the monetary policy framework. So, the exchange rate regimes goes alongside the monetary policy framework of a country. This has a significant role in broad economic policy and help identify the inconsistency in the monetary exchange rate policy mix. Now, we have discussed previously also whether it is a free float system or a managed float system. Somehow the government of a country or the central bank, they will intervene whenever there is a problem. So, through monetary policies, they make the changes so that they can maintain the exchange rate. Uh, in a purely free float, there is minimum intervention, but in other types, there is an intervention. There in the framework, the following factors may be there, or that is monetary aggregate anchor, exchange rate anchor, inflation targeting framework, fund supported or other monetary programs, and other factors. So, we will discuss this whole monetary policy framework one by one. So, first is monetary aggregate anchor. The monetary authority uses its instruments to achieve a target growth rate for a monetary aggregate such as the reserve money. So, the targeted aggregate becomes the nominal anchor or intermediate target of monetary policy. So, this is the monetary aggregate anchor. The second is exchange rate anchor. So, they maintain it with the exchange rate. The monetary authority stands ready to buy or sell foreign exchange at given quoted rates to maintain the exchange rate at its pre-announced level or range. Now, India is a country where we have a managed float system. So, thereby when the exchange rate becomes unfavorable, or you find that the value of dollar is increasing and the rupee is dwindling, then the central bank intervenes and it buy more and more of one currency, so that again it will go to the predetermined level. So, if we wish to maintain the ratio of dollar to rupee at 90:1, so then naturally if it is going beyond that, that is it is becoming 92:1 or anything, then the central bank will intervene. The exchange rate serves as the nominal anchor or intermediate target of monetary policy. This covers exchange rate regimes with no separate legal tender, currency board arrangements, fixed pegs and crawling pegs. So, all these are covered under exchange rate anchor. The next is inflation targeting framework. We have discussed this in detail earlier also. This involves the public announcement of medium term targets for inflation with an institutional commitment by the monetary authorities to achieve these targets. The features include increased communication with the public and the markets about the plans as well as objectives of monetary policy makers, and increased accountability of the central bank with respect to the inflation objectives. Then another is fund supported or other monetary programs. So, this involves implementation of monetary and exchange rate policies within the confines of the framework. This establishes floors for international reserves and ceilings for net domestic assets of the central bank. The indicative targets for reserve money may be appended to this system. And finally, there may be other factors which may trigger monetary policy. The country can monitor various indicators in conducting monetary policy, like the inflationary conditions, income levels rises, reduction in the value of domestic currency. In all these possibilities, the monetary policy will be framed to intervene to maintain the exchange rate between your own currency and any foreign currency. So, this is the whole framework of the monetary policy. Now, let's summarize whatever we have studied in this lecture. So, there are various types of foreign exchange market prevalent nowadays, like spot market, forward market, futures, options, swap transactions and arbitrage. Exchange rate move in line with changes in demand and supply of currency. So, if it is a free kind of a free exchange rate system, so the demand supply curve will determine the exchange rate. But most of the time intervention of central bank or the government is there. The factors that there are other factors also which causes some change in the exchange rate. The factors that cause changes in demand and supply of currency and the exchange rate are the relative price levels and the relative income level. That we have discussed, that when there is an inflationary kind of condition, the value of the foreign exchange or for foreign currency may appreciate and your own currency may depreciate. Likewise, when there is rise in income, then people will demand foreign commodities, so the value of foreign currency will appreciate and your own currency will depreciate. In such situations, the government may intervene. Exchange risk and exposures are always there when you are doing business in international business or international market. So, exchange risk and exposure means the possibility of loss due to the fluctuation in rate of exchange between two or more currencies. There are three types of exchange risk. One is transaction or conversion exposure. Since there is a time lag between entering into a transaction and actual delivery of the product, so by the time the exchange rate foreign exchange rate may change and that may lead to some risk. Then there may be translation or accounting exposure when you have foreign subsidiaries and your assets and liabilities in the foreign subsidiary are measured or valued in terms of foreign currency, and when you are accounting the same in your country and converting it into your own currency, then there may be a risk. And then the third one is the economic or operation exposure, which any changes in the economic conditions may lead to changes in the exchange rate, and this exchange risk may be there. Then we have discussed the methods of managing exchange risk, and this may be divided into internal methods like exposure netting, denomination in local currency, foreign currency accounts and leads and lags, and external methods like hedging, futures and options. Finally, we discussed the monetary policy framework, because the exchange rate regimes goes alongside the monetary policy framework of a country, and in this specifically we have discussed the monetary aggregate anchor, exchange rate anchor, inflation targeting framework, fund supported or other monetary program. So, with this we have completed this portion on overview of exchange rate system. For your reference, books are one by C.B. Gupta, this is an S. Chand publication, Sumati Verma, which is a Pearson's publication, Neeta Tripathi is a new book and it's a Taxman publication, and then you can refer to e-Pathshala website, Chaturvedi and others. This is again a new book which you can go through, and Hill and Hult is a foreign author book, and this is a McGraw-Hill publication. So, if you have this a hand to this copy, you can also go through it. Have a good read and have a nice day, students. Thank you so much.